Hi everyone, and welcome to the Everyman Investor. Today I'll be sharing on getting started with equities. So to me, investing in equities is like playing a strategy game. You need to know the rules of what to do and what not to do so that you can hopefully profit based on your investments. And also, by knowing the rules, you know what not to buy and what you should buy to have the greater chance of earning a profit in the stock market. So let's look at the great man, Mr. Warren Buffett, who is probably known as one of the greatest investors ever. And let's see what his rules of investing are. So, Mr. Warren Buffett has got 5 famous rules of investing. The first rule is never to lose money. The second rule is never to forget rule number 1. The third rule is if the business does well, the stock eventually follows. And the fourth rule, which is my favorite, is better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the fifth rule is our favorite holding period is forever. So the reason rule number 4 is my favorite is because if you buy a wonderful company at a fair price, if the business does well, the stock will eventually rise, which means to say you will be profiting, which means that you are following rule number 1, rule number 2, and rule number 3. And should the company continue to develop its business and continue to grow its earnings, you can hold on forever, which is rule number 5. So for those who are in sort of investing in stocks, there's the investor and then there's a trader. So the difference between an investor and trader is an investor buys a wonderful company at a fair price. An investor tries to understand what the company does, what is the business plan of the company. After all, he or she is going to take an ownership stake of a company that is hopefully a wonderful company. The holding period typically for investors is for the medium to long term, and the investor will sell when the business plan is no longer delivering increasing earnings. For a trader, on the other hand, a trader uses charts, statistics, and various trading patterns, which I still am struggling to figure out to this day. And from those patterns, the trader buys and sells when various indicators show that the stock price is possibly or probably going either up or down. A trader might not actually own a stake in a company or actually understand what a company is actually doing. A trader might trade in options, which is basically just making a contract with a broker to decide if the stock price is going up or down, and trader profits from the difference between the buying price and the price that is the stock actually lost or the stock gained, depending on what is the contract. The traders' trades are usually fast-moving trades, from intraday trades or even a couple of hours to maybe say days to weeks. Typically, options traders do not hold for the long term for the simple reason there's a commission on options tradings, and the longer you hold on to your options position, the more in commissions you have to pay. So in summary, as an investor, what we do is we buy a wonderful company at a fair price. We go for holidays, looking at the nice scenery, and we let the company's business run along, earn more money, and the stock price goes up, and we profit from it. Now, a trader, on the other hand, has a very intense sort of investing environment. He or she has to study the charts, the patterns, and all, and has to make quick decisions when to buy and when to sell. So I'd like to introduce this concept called the equity risk premium. The equity risk premium is very simple. It's a long-term prediction of how stocks will outperform or underperform risk-free investment vehicles. The reason we need to know this is because it will help us decide whether or not the added risk of owning stocks is worth the while. So the formula is very simple. It's the expected returns from a stock or stocks minus the expected return from risk-free investment vehicles. So an example would be if you hold the SPY, which is the S&P 500 ETF, the long-term annualized returns is 8.9% per year versus, say, the peak treasury yield for 2 years at 5% returns. The equity risk premium will be 3.9%. So in short, for taking the risk that the S&P 500 ETF will drop versus, say, the treasury yield, which will stay constant at 5%, you are hoping that you can gain an extra 3.9% of profits for taking that added risk. Now, however, there are other extrinsic factors to consider. So, for example, some countries do have capital gains on stock profits, and I had a look on Google to try and see what the capital gains tax is in US. So apparently the ballpark figure is about 15% or so. So if you add that in, the SPY annualized returns actually drops to 7.57%, minus the 2-year Treasury yield of about 5%, and your added returns is only about 2.57%. So depending on your risk appetite, you might or might not want to hold stocks in that case. So let's look at how retail investors, people like you and me, actually do perform in the stock market. And the color of the text should give you a very sort of good spoiler as to how retail investors actually perform. So per Financial Times, more than 70% of DIY investors actually lose money in the stock market. And the reason for that is because they hang on to losing trades for too long and they exit successful positions too quickly, lock in profits. So how about the professional guys that say we know that we are probably going to lose money since more than 70% of us do it? Let's turn our money over to the professional guys. So per the S&P data, for global equity managers, if you hold on, the longer the holding period, from 1 year, 3 year to 5 year to 10 year to 15 years, the percentage of global equity managers who actually underperform the index actually goes up higher and higher. At a 15-year holding period, more than 80% of global equity managers actually underperform the index, which is not exactly great. So let's say that this is a global equity manager performance. So what about the guys who are US based and who know the US markets better, we assume? Okay, similarly, per the S&P 500 data, so the percentage of US equity managers who underperform the index is actually higher than their international counterparts, at more than 80% again, of over a holding period of 15 years. In short, the retail investor is likely to lose money in the stock market. Turning the money over to a professional investor or manager is probably not going to be a good idea either. So should we actually invest in the stock market? Okay, so let's take a look at the S&P 500 ETF Trust, which is the SPY, for since inception. So at the time of my preparation of this presentation, this is how the chart looks. So I'd like to point out a few significant dates. So let's look at July 2000, which was the peak before the dot-com bubble burst. The market shortly afterwards entered a bear market that lasted for many years, and then subsequently a new bull market returned until October 2007, whereby that was just before the global financial crisis. Again, the stock market entered a bear market subsequently, and if you had bought in either July 2000 or October 2007, you would have had to wait until January 2013 before you were able to break even on your investment. So over a period of 12.5 years, had you bought in July 2000, or over a period of 5 years or so, had you bought in October 2007, you would have had to either take the loss or you would have to hold. Now, people like you and me who have got limited financial ability to hold, we work with budgets. We have got expenses to pay. Sometimes we won't have additional expenses. For example, we need to buy a house or we need to buy a car, for example. We might need the money that we have in equities to fund those purchases. And unlike those 1%ers who have got tons of money and they can just throw it everywhere, we actually do have to watch our budgets very carefully. So if you had bought in July 2000 and say in 2002 you needed to buy a house because you were getting married or you had your first kid, and you needed the extra funds, you would have to take a loss, and that is my postulation as to why so many retail investors actually have to lose money in the stock market, because we are unable to hold for such long periods, hoping to recoup our losses. Now, had we followed the dollar cost averaging model, which is a common model that people use to either increase their gains or to reduce their losses, here's what would have happened. So this is the same chart. Had you bought in July 2002, bought halfway down the bear market, and bought again at the bottom of the bear market, your dollar cost average would have come out to right smack in the middle where you bought in the middle of the bear market. And you would not have had to hold so long before you were making a profit or before you were not making a loss. So instead of having to hold until October 2007, you would have probably been able to get back your investment in 2006 or thereabouts. And actually, during the bull market that followed the bear market for following the dot-com bubble burst, you would have actually managed to get profits. So dollar cost averaging does work to a certain extent to minimize the time you have to hold or to reduce the time you have to hold before you can actually break even or get profits. But does it work in every instance? Okay, so this is the chart of Cisco Systems, which is one of the companies, it's a tech company that benefited from the dot-com bubble. So let's take a look at April 2000 when the stock peaked at about $80, and again at the bottom where it was about say $10 or so. Had you diligently done the dollar cost averaging, you would have bought the shares slightly above $40, and unfortunately you have been in the red all the way until the bull market just before the COVID crash happened. So that would have been a holding period of approximately 17 to 18 years, whereby you would have been having losses, or you had to take the loss if you needed the funds. So dollar cost averaging does not work in every instance, and so this is where the rules that we follow when buying stocks will help us to hopefully profit more from the stock market. So the question is, if the retail investor is not doing well, if the professional money managers are not doing well, if even dollar cost averaging fails at times, can we actually make money in the stock market? Okay, so this is my portfolio, stocks that I handpicked for my own portfolio that I have bought since. If you look at it, I put it over a 2-year period, and this chart can be obtained from stockrover.com. You can sign up for a free account. It's totally free, and they can give you the option of putting in your portfolio. So what I did was actually I entered one share at the cost price that I bought the share for, and they gave me this chart of how my portfolio has performed over the past 2 years. As you can see, the line in blue, which is my portfolio, is actually outperforming the market significantly. Is up by about 12%, whereas the market is up by about say 3%. So I'm outperforming the market by about 9%. But this portfolio was only started a year ago. As I mentioned previously, my initial investments were based on stock subscription services, and frankly, it did very badly. So let's see how I actually did in a 1-year period since where I stopped listening to the pros, apparently pros, and I started to buy stocks that I picked myself at the value that I thought was fair value. Okay, so a look at this chart would basically prompt a question of how did you know how to time the market bottom? Now, in the first year that I started investing in the stock market, I only learned 2 things because the data was overwhelming. So the 2 things I learned were, from the losses I had suffered from those subscription services, I learned how to identify wonderful companies. And also, although several of the companies I identified were actually part of the portfolios of the subscription services, I noticed that the value that they bought the stocks for was at an extremely high premium to what fair value was. So in October last year, I noticed that many of the wonderful stocks that I had identified were trading at not just fair value, but below fair value. And that's where I did a lot of buying. I had absolutely no idea that the market had bottomed. And honestly, if the market had dropped even further, I would have expanded my positions in those stocks. So as you can see, just by following the rules that I followed, basically buying a wonderful company at a fair price, the subsequent returns have been really quite good. I'm up about 36% or so versus the market at 15%. So basically, there's a 20% outperformance versus the market index. Okay, so what rules do I follow besides the rule that I often state, which is to buy a wonderful company at a fair price? Let's start with what I do not buy. Okay, I do not buy companies with decreasing earnings. That is a hard no, for the simple reason a wonderful company should be increasing its earnings. A company with decreasing earnings is likely to lead, it's not likely, it's almost inevitable to lead to a loss of the share value. Okay, I do not buy companies with poor financials. Mainly, I look at the operating income versus the interest expense. So there's a term called the interest coverage ratio, which is recommended to be less than 3 times as a poor interest coverage ratio. So how it's calculated is that the operating income, which is basically how much the company earns from its operations, over the interest expense, as all companies have got debts to banks, they borrow to expand their businesses, they have to pay interest all the time. And these interest figures can be obtained from the company's quarterly earnings reports. So basically, assuming a company has got 9 million in operating income and has to pay 3 million in interest expense, its interest coverage ratio will be exactly 3 times. Now, a company that makes 9 million, for example, and has to pay only interest expense of 1 million, has got interest coverage ratio of 9 times, which is considered as very good. So comparing the two companies, one company will have 8 million to invest in expanding its business versus the other company that has 6 million to invest in its business. It's obvious that the company with more that they can invest in their business will grow more. Okay, I do not buy companies that are founded and headquartered in China for the simple reason the governance is very opaque. As it is hard enough making money in the stock market where companies are actually required by law to file quarterly earnings, and all the data is available for an investor to go through to see whether the company is actually doing well. I also do not buy companies with geopolitical risks, for example, TSMC. So if you follow the markets closely, Warren Buffett actually bought a stake in Taiwan Semiconductors because he thought it was a great company. But then he actually sold off his entire stake because he felt that the geopolitical risk was too high for him to take. I don't like service companies, for example, banks or fintech firms. The simple reason is that if a company only provides a service, a bad customer service relations officer is likely to drive business away, and it is very simple to find alternative banks or fintech firms or any other company that provides a service with, say, a better customer service relations officer. So I do not like to buy service companies for that reason. I do not buy drug makers for the simple reason they live and die by the drug they create. As a healthcare professional, I have seen drugs come along and basically go out of favor within sometimes months, sometimes at most say 5 years or so. So from just that personal experience, I do not buy drug makers. I also do not buy companies that do harm. This is just a personal preference. There's nothing wrong with buying a company that is doing well. For example, certain tobacco companies actually pay great dividends, but I would never touch the stock because I would not want to encourage these companies to survive. I do not buy options. I'm an investor and I'm not a trader. To me, I still cannot figure out how all these charts and figures work. Okay, so like I said, China has got very opaque governance. So we still have no idea what exactly Jack Ma or Alibaba did to make him disappear, or to make the authorities make him disappear and then to reappear, and nobody has a clue what is going on still. So that's why I do not buy stocks that are headquartered or founded in China. Okay, what do I buy? Okay, so I only buy companies with growing earnings. Okay, that is basically how companies grow their stock price. Company with growing earnings, inevitably, the stock price will go up. Okay, I only buy US equities for reasons that I will share in my next slide. I buy companies with a product we can't do without. That is a personal favorite of mine. For example, this presentation was made on Microsoft PowerPoint, and I grew up in school, uh, undergrad days, postgrad days, at work, teaching, using Word, Excel, and PowerPoint. I cannot imagine not having Microsoft Office on any computer that I'm using. So to me, that is a product we cannot do without. I like market leaders in their respective areas who are continuing to grow and innovate. So market leaders that stagnate are not companies that I would look at. I like companies with disruptive technologies. So, for example, the latest hot company is OpenAI, which owns ChatGPT. The thing is, it has not IPO'd yet, which means hey, you cannot buy stock in the company. But there is a company that basically has got great investments in OpenAI, which when OpenAI goes IPOs and goes on the stock market, that company will probably do very well. And that company is Microsoft. And yes, I do own Microsoft shares. Okay, I like companies with multiple revenue streams. So the thing is, for companies with multiple revenue streams, certain aspects of the business will inevitably be doing well, certain aspects will be doing badly as the macroeconomic environment changes. The idea is that you want to pick a company with multiple revenue streams so that the revenue streams that are doing well can compensate for those that are not doing so well, and when circumstances change, the revenue streams sort of switch between doing well and not doing well. But overall, they must actually be growing as well on a whole company basis. Okay, so the reason why I only buy US equities, if you just Google follow Wall Street's leads, these are all the headlines that come out. Basically, every market follows Wall Street's lead. So if Wall Street is down and there is no good news in whichever home market you are in, the stock market will probably drop. If Wall Street is down and there is very good news in whichever market you are in, the stock market might go up a bit, but it might just stay flat or it might even go down just a bit. In general, all markets follow the lead from Wall Street's previous close, unless there's something exceptional going on in that particular market. So to me, as a person who has a job and basically invests in the evenings or at night where I do my research on what stocks to buy, I find it a lot easier just to focus on one country which has the biggest economy in the world with a stock market that basically leads worldwide exchanges in terms of the trends. Okay, so lastly, I would just like to cover what brokerage account I use. So there are two ways to buy stocks. One is to use a bank brokerage account, which I do, versus using an app, which there are many out there nowadays. So I'm not doing any advertisements. None of the apps in the picture actually belong to any brokerage company as far as I can tell. Okay, so what is the difference? Okay, so firstly, what broker to use? Use a provider that is too big to fail. The bank that I'm using is quite literally too big to fail. The US government will never allow that bank to fail. Okay, then you must consider custodian fees. So banks typically charge custodian fees. Certain brokers do as well, and certain brokers do not. The fees are usually quite minimal. So to me, the fees are a fair price to pay for knowing that the stocks will never disappear. Okay, then there are transaction fees. So depending on which broker you use, some brokers charge by a percentage of what you buy versus a flat transaction fee per transaction. So the broker that I uses actually charges a flat rate per transaction. So when I started buying, I used to buy in lots of $1,000. So the transaction fees actually did eat a bit into my ability to get profits. Nowadays I buy in bigger lots, but that is with experience and a better feel of how the market works. Then there's interest on unused cash. So if you put your money in the bank to use for the bank brokerage, there will be interest. And given that the Treasury, US Treasury rates have been going up so high, the bank interest rates do go up higher as well. Now, I have seen advertisements on a certain brokerage app that basically advertises a really good return on unused cash. However, usually if something is too good to be true, it is probably likely to be too good to be true, and I have not gone into the terms and conditions of it because I'm very happy with my brokerage. Okay, then there are bank perks if you use a bank brokerage. So the stocks that you own in the brokerage account of a bank actually count towards your assets under management. And the assets under management, the quantum, is basically used to upgrade you to higher tiers of membership in the bank. So if you do invest for the long term and you continually invest, you will probably be upgraded to having a personal relationship manager who will basically take your call, set up an appointment for you, and can skip the queues at the bank. Okay, so for the purpose of this presentation, I actually did try to find out what happens should your brokerage go bust. And there are actually legal protections. So do not worry about your brokerage going bust. But the problem is, and the catch is, it will take time to transfer your existing stocks to another account. Assuming your stocks are doing very well, while your brokerage has gone bust, you cannot access those stocks to sell to get the profits. By the time it takes in the time it takes to transfer your stocks to another account in another provider, the stock might have gone down. Similarly, you might have been on minimal losses that you wanted to close your position on, but you do not have access to your stocks, and the losses get worse by the time you open another account. So thank you for watching this video. I hope it was useful for you. In my next video, I will basically pull back the curtains on paid subscription services for stock picking, and I will show you the actual real life returns so that you can make an informed decision about whether or not that will be your first starting line to your own investment journey. So thank you, and I hope this was useful, and I hope to see you soon.